Great, thank you, Heather. Morning, Mark.
Morning, Mark.
Did you say snow, Kelly, already?
Yeah, I think we're supposed to have some flurries tomorrow. So
Wow.
yeah, it's always tough this time of year. Actually, when we have snow, it insulates a little bit better, so it feels a little bit warmer. But this transition into winter is always. I've been enjoying my morning walks without snow and ice, so I'm not looking forward to the transition. So.
Trustee Martin, you do have a quorum. We do expect Jim Donnelly to join, but we can proceed if you want. You have a quorum.
Okay, great. So I'm going to call the University of Maine System Board of Trustees Investment Committee to order. And I'll ask the clerk of the board, Ellen Dowdy, to take a roll call for the meeting.
Certainly. Good morning, everyone. Mark Gardner.
Present.
David McMahon. Oh, you're on mute, David. Nope, we can't hear you. We'll come back to David. Trustee Martin.
Here.
My concern is we will need Trustee McMahon to take a motion on our first item.
Okay. Let's just wait a minute or two, and
if need be, I can have him. If need be, I can have him phone my cell phone and connect that way so we can hear him.
Okay. He's left the room. I don't know if he's gone to try something or gone to get headphones, but we can also probably move an agenda item, right?
Yes, you could.
Okay.
Oh, here's David's back. Let's just see.
He's got his iPad. He's getting hooked up a different way. David, can you hear us? Okay. Do we want to move ahead with the explanation of tab 1 and assume that he'll be up and running, or make a call in for the first item on the agenda? Oh, he needs to be in for the roll call, right?
Yes.
Okay. Oh, I see him.
I'm on an iPad now. Can you hear me?
Excellent.
You'll have to disconnect your computer because we're getting feedback.
That better?
Oh, that's perfect. Trustee McMahon.
Present. Sorry about that.
Wonderful. We are all set to start.
Excellent. So welcome to the meeting, everybody. Normally we have this meeting in December. It's a little bit earlier this year, in right before our board meeting. So I'd like to remind all the meeting participants to please leave your mics muted when not speaking. And I'm going to introduce the first item on the agenda, the FY 2023 endowment spending rate. And I'm going to transfer this over to Tracy Elliott, who's a Vice President of Finance and Controller for the University of Maine System. Tracy, without further ado.
Thank you, Trustee Martin, and good morning, everyone. As mentioned, this action item is the endowment spending rate for fiscal 23. The current fiscal year 22 endowment spending rate is 4.5%, and that's the same rate as the foundation, the University of Maine Foundation has, and is estimated to generate for the university $4.8 million in endowed spending, which is primarily scholarships, and $1.2 million for the internal management fees charged by the University of Maine, the University of Southern Maine, and then a small one for governance and university services. The total to be distributed the current year is $6 million. The chief business officers recently met and reviewed their endowments and the rate that they desired for the fiscal 23 year, and are asking for you to approve the same 4.5% spending rate. And this provides an effective rate of 3% after adjusting for those campus management fees for the 2 campuses that charge them. Included in your meeting materials is the NEPC's most recent rate of return analysis for the managed investment pool, which is where our university endowments are primarily invested, and demonstrates that the 4.5% spending rate can be supported. Their analysis suggests a return expectation for the MIP in the range of 6.6 to 7.7%, which includes 50 basis points for active management based on a 30-year return expectation. Their analysis therefore substantiates the MIPS returns assumption of 7.25%, fully recognizing there'll be volatility every year around that return. With the approved rate, the accounting department would then send out the endowment budget so that the campuses could plan their awards for fiscal year 23. And that's my summary in a nutshell, but happy to take any questions before your vote.
Any questions for Tracy Elliott? Hearing none, I would like to read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves an endowment spending rate of 4.5% for FY 2023. Do I have a motion?
So moved.
So moved by
Second.
Trustee Gardner, seconded by Trustee McMahon. And Ellen, you take a roll call, please. A roll call vote, please.
Trustee Gardner,
Yes.
trustee McMahon,
Yes.
trustee Martin.
Yes,
The motion is carried.
excellent.
Thank you.
So on to tab 2 to discuss the defined contribution plan quarterly review. So I'm going to transfer the floor to our consultants, Mike Pratico and Barry Schmidt, to give us a quarterly review.
Tracy, would you like me to just share my screen, or is it easier for you to share your screen?
If you'd like to share yours, if that's easy enough. That would be
Okay,
great.
that's fine.
Thank you.
Can you see that okay?
Yes.
I actually had to go up a little bit here. Good morning. As you all know, as part of our normal cadence, we want to make sure that you are no more than 90 days out of things that are happening in play in the marketplace, trends that we might be seeing, things that we might want to discuss with the committee. So we have several, we think, important topical spotlights that we want to cover today. I'm going to cover the topicals. Mike's going to cover the market review. I'm going to give it back. He's going to give it back to me. I'm going to cover the review itself, and then we're going to follow up at the end with the fiduciary training discussion. So, one of the things we've been spending some time on is the appropriate committee design. There are certain attributes of a committee or of an effective committee. Certainly the right mix of talent, certainly, non-financial, financial persons, certainly the engagement of the committee, making sure the committee is engaged in this process. We don't ever have any issues with the engagement of the humane system, but it needs to be an actionable committee. And then last but not least, not only diversity, but also diversity of thought, making sure that people have different perspectives when they're coming to the table. What we find most committees is somewhere between 5 to 10 committee members. Some are a little fewer, some are a little bit more. The important thing is that the committee is actionable. They understand the issues, and we have appropriate tools in place to fulfill your duties. You do have a committee charter. Thank you, Tracy. And, that has certain roles, responsibilities defined within the charter. That's something that we found most effective in committees just from a governance perspective. But, again, we don't see any issues, anything that we are concerned about from the UMaine committee. The second item is the Department of Labor came out recently with some guidance on rollover transactions. You think about TIA, the most recent settlement that TIA had in terms of rollovers, and the Department of Labor wanted to make sure that there are certain rules that are followed in regards to rollovers. When a rollover is occurring, the participant relies heavily on the faith of that particular vendor. And so this rule is basically an exemption because they're going to make more money in a rollover. They're going to use their own product set. And so there needs to be an exemption for vendors like TIAA to accommodate rollovers. Think about the TIA settlement recently when they went back, the New York Attorney General, they settled it for like $97 million, where they weren't providing enough information. They weren't providing comparisons, and all of these types of, this rule in particular is making it mandatory that they provide certain information to participants before they make the decision whether or not to roll over their money. What we think ultimately will take place is really the third bullet point on the right, is it's probably going to result in more assets being retained within the plan. If you think about all the work we've done in keeping your fees really competitive, we're thinking that more and more participants will keep their money in their plan beyond retirement. The other thing, just to keep in mind, I know you're a non-ERISA plan, but the fee litigation is accelerating. Some of the private institutions that we've talked about over the last several years, they continue to they're continuing in the press, the 401k plans, private sector plans. You think about 2020, there were 97 ERISA fee lawsuits filed in the year 2020. So far in 2021, almost 23. One particular vendor, this is not the vendor that was in the press with like the NYUs and the Cornells of the world, but Capozzi Adler has represented about 40% of those. They've had 2 trial verdicts, and most often it's going to be a settlement. I mean, they don't want to drag through years worth of activities that typically they settle at some point. But it's just important to know that we do really important work here as a committee. It's important to understand fees, to understand share classes, understand record keeping fees, and that we're very diligent in that process. And we've had a pretty a well-documented process in terms of making sure we are competitive in the marketplace. But it's just something that just to keep in mind. The last item before I turn it over to Mike is, we're going to talk today about fiduciary roles and the responsibilities, just as a precursor to the brain chart that we'll send following this meeting. But it's really important for you all as trustees to take the time to understand what your roles are, to make sure you are adequate, you have the tools and resources adequate to fulfill those particular rules. And Mike will talk about that a little bit later. Before I turn it over to Mike on the market, is there any questions on anything that I've covered thus far?
Okay. Thanks, Barry. If you don't mind just retaining control,
Yeah.
so I'm going to be bumping it back over to you. We'll start, as you can see, on page 16, and I'll do a relatively brief overview of the market and include hopefully some forward-looking commentary as well. But as you can see on this page, the third quarter through September 30 was a bit mixed, really for the most part flat across most asset classes. S&P 500, which is large cap stocks, about 60 basis points for the quarter. through through the close of the third quarter on a year-to-date basis, which is that solid bar, up about 16%. We've certainly seen dramatically improved numbers since the close of the quarter. The S&P through Friday up about 26 and a little over 26.5% on a year-to-date basis. So you can see that the third quarter, we really again had some fairly mixed results. The Delta variant, we had this just amazing swing from the second quarter. It seemed like the virus was close to being in the rearview mirror. The third quarter, we saw some variants really kick in and the numbers spike again. And then there are a number of other factors that I'm going to talk about in a minute that caused some mixed results in the third quarter. International equities similarly down 40 basis points for the quarter, but up almost 9 year to date. That number has improved as well. Your total international index, sorry about that. Total international index is actually up about 11% year to date through Friday. Emerging markets, the return's a bit more muted, down about 8% for the quarter and down for the year as well. That is for the most part driven by China. Emerging markets are predominantly driven by China. And then some of the alternative asset classes like real estate and commodities actually doing very, very well year to date. As you can see, up over 20% in the case of real estate and almost 30% in the case of the commodities driven largely by energy. The one really weak area that continues now, again, through the close on Friday is bonds. And that's really a function of interest rates. The aggregate bond index, you can see down about 1.6% for year to date. And that really continues. The aggregate bond index now down about 1.2% through Friday. So if you jump to the next page, Barry, just kind of digging a little bit deeper into the markets, you can see that we talked in the fourth quarter of 2020 and the first quarter of 2021, we really talked about this kind of rotation in the market back to value. So where we really had been predominantly in a growth-oriented, risk-on market for 2019, 2020, we really did start to see that swing back to value, back to some degree of normalization, really, in the fourth quarter and first quarter. You can see in the third quarter, growth was really the only asset class that closed out, large cap growth, I should say, was the only asset class that closed out positive and really driven a lot by big tech. But I do want to emphasize, if you kind of look at that middle year to date 2021, really all asset classes are positive, but value continues to outperform growth on a year-to-date basis through the close of the quarter. The only other thing on this page, and Barry's going to talk more about the impact of this when he talks about your fund specifically, is that 10-year Treasury up in the upper right-hand corner, you can see remained largely unchanged, I should say, for a while there. But when you look at the difference between 9/30/2020 and 9/30/2021. So basically the last year through the close of the third quarter, really dramatic rise from 70 basis points to 150 basis points. That really, is kind of explains a lot of what's going on in the fixed income market and why we're seeing some of those negative numbers where spiking, yields have that kind of opposite effect, if you will, on bond funds. I do like to point out, in the case of the UMaine System Plan, it's one of the reasons why we think, having that TIA traditional in the plan, for people who are in retirement or approaching retirement, certainly provides that nice safe haven, if you will, where if you're, concerned about the volatility of the equity market, you're frustrated with the inability to really do much with bonds right now, having that TIA traditional certainly continues to be, we think, an appropriate and good option within the retirement plan. So if you jump ahead, Barry, to a couple pages to the headwinds and tailwinds page, I did want to just provide a little bit of forward-looking commentary from CapTrust perspective. And just to summarize, we continue to certainly be optimistic for the balance of 2021. There's a lot of positive things which are summarized here on the tailwind side of the page. But there certainly are some headwinds that are impacting the market. And we think ultimately will continue to impact the market as well. But overall, when you kind of when you slice up, if you will, the different factors that really impact our economy, the Federal Reserve continues to be very accommodative. That's certainly a positive thing. Inflation is another thing that we're keeping a very, very close eye on. I think anyone that deals with the markets is always looking at inflation. But right now, this whole debate between how much of this inflation that we're experiencing is transitory and how much of it is truly going to be long-term in nature. We continue to believe the inflation we're experiencing is largely going to be transitory. Part of that, is being impacted by these logistical log jams that we're experiencing, which hopefully are going to, get worked out over time. I'll talk a little bit more about that. Some other things that are kind of potential headwinds is certainly the issues with the labor market, the inability to continue to fill some of the jobs that are available. It's just remarkable to this day, just anecdotally, to see businesses that continue to be open in limited hours, limited days, in some case, not able to reopen at all because of the inability to find workers. And then businesses that do have the workers are clearly paying higher wages as a result of that. So certainly a headwind that we're keeping a close eye on. But from a positive perspective, consumer spending continues to be strong. We did definitely see a slowdown in the third quarter, but we're looking as we get into the holiday season for consumer spending to continue to improve and be strong. Our economy, for better or worse, is about 2/3 driven by consumer spending. So consumers, continue to do their part. Hopefully, some of the logistical logjams, supply chain shortages, are going to start to get worked out, especially going into the very important holiday season. And then the final piece, again, is really just the virus. As we continue to hopefully see developments around vaccinations, the numbers are obviously frustrating for everyone. The virus, the variants are all very frustrating on many, many levels. But the hope is that we continue to get vaccination rates up, virus numbers start to come down, and that we can start to continue to see what has been a remarkable economic recovery continue. So overall, again, we continue to be certainly optimistic for the balance of 2021. If you jump ahead to page 14, the next several slides really go into kind of the details of the headwinds and tailwinds, but I did want to just pause on page 14. It's a slide that I think is really important because the ripple effect that this has on our overall economy is very dramatic. And this is just a snapshot in that chart on the right-hand side of some of the things that we're seeing going on, specifically in the Port of Los Angeles. And those green dots are basically cargo ships that have been sitting in the harbor for up to 6 months waiting to be unloaded. That's something that the administration has tried to deal with by getting, going to a 24-hour-a-day workforce. But even with that policy, the issue is finding people to fill those jobs, I should say. And then once those goods do get to the mainland, then there are logistical issues around, getting them to market at that point. So this is really a very, very important slide. It's a very important topic that really needs to get worked out. Again, if you think about the U.S. economy and how important it is for consumers to be able to spend money, basically, especially now where there's so much more money out there, in consumers' hands, this is something that's going to have a dramatic, potentially positive or continued negative impact on the economy. So again, in summary, I would say, the third quarter was certainly a mixed quarter. As we approach the midpoint of the fourth quarter, things have really dramatically strengthened as a result of improved consumer spending, very, very strong corporate profitability, and we think, hopefully continued developments around, getting the virus under control. And I'll pause there and see if there are any questions at all on kind of any of the macro level economic commentary before I turn it back to Barry to talk specifically about the UMaine system plan. No? Okay, so Barry, I'll turn it back over to you.
Thank you. we have a couple new charts in here, so we're always interested in your feedback in ways to display the information rather than display each individual plan and each individual asset. We've tried to summarize that, so I'm always interested in feedback and ways that we can provide that information more succinctly or better. So the UMaine plan as of the end of September was about 1.9 billion. If you look at where the dispersion of assets are, you'll notice in particular, we did have that conversion into the group contract. So in 2020, I believe, and so we'd have about 54% of the assets in legacy, in the form of legacy contracts. If we look at this based on descending market value order, the legacy contracts represent about 54% in total, and that's all of them. So that's all the CREF annuities, it's TIA traditional, that's TIA real estate, et cetera. So those in combination are 54%. I'll have a slide here in a second that has the breakdown of those. But the Vanguard Target Retirement Series is the second largest asset class, obviously appropriate for those that don't make election. It's the default. Those that even electively select the Vanguard Target Date funds, very appropriate for probably 80 to 85% of your population. Once we get to those, it starts to drop pretty precipitously. For example, the institutional index or the large cap growth, that tends to be pretty popular in most allocations. Large cap growth is certainly garners a lot of assets. You have self-directed accounts. Again, that's a lot of that is also legacy. When we took down the vendors from 4 down to 1, a lot of the participants that wanted to invest a certain way got into self-directed brokerage accounts. So that tends to be a pretty popular program. And then again, going down to all the way down to about a little over like 0.0001% of the assets. If you look at the legacy contracts, the breakdown of the legacy contracts has the $1 billion in total. TIA traditional represents 513 million of that. And as you recall, this is a 3% minimum guaranteed account. And Mike had talked about that earlier when we looked at kind of the current interest rate environment. That's a very good vehicle. We're highly convicted in that. But you notice that there's a lot of dispersion of assets amongst the other asset classes. One of the things that we'd like to do more longer term is perhaps set on a path or a strategy on educating participants a little more fully on some of these legacy annuities. So for example, the CREF bond market, there is a reason we don't have the CREF bond market as a vehicle going forward. There's a reason we don't have CREF equity index in the plan going forward, whether that's fees, whether that's performance, et cetera. So one of the things we would like to do, we touched base with Tracy last week and Kelly on this, is perhaps creating some sort of strategy and just educating participants on maybe exploring migration into the core fund menu. Certainly from an asset class perspective, like from a fee perspective, like the equity index, for example, is like 20 some basis points. We have the Vanguard institutional index, I think at 4 or 3.5 basis points. So, the more we can engage participants in that, the more we would think that they would move more towards the core and monitored menu. And that's kind of a long-term play. This is not unique to the University of Maine system. We see that kind of pervasive throughout the higher educational marketplace, especially when you migrate to group contracts. Any questions on that?
Barry, I do have a question on that. The migration is, you're talking education, is it one-on-one? You offer education and then they meet one-on-one with somebody, or are they to do that themselves, the migration?
No, this is a more of a pessimistic comment first, that I'll kind of go about a different way. But when TIAA engages with a participant, they use Morningstar downstream, as we all know, for that advice. When they are engaging in your contracts, where you have two contracts, you have the legacy contracts and then your group contracts, they are doing two separate advice sessions, if you will. So they're going to say, okay, based on your legacy contracts, what's the best allocation we can come up with for your legacy contracts, separate and apart from the core and monitored menu Morningstar advice. And so what happens is, as a result of that, Kelly, is they almost never recommend you migrate from the legacy contracts to the group contracts. They're just not set up that way. And so that's just and so the way we would educate them is saying, hey, it's probably a humane driven communication to say, hey, you might want to consider moving this, and maybe there's some information that we can provide to spur some of that discussion. But if they engage with TIAA, they may or may not actually ultimately migrate assets. I don't know if there's anything, Mike, you want to add to that.
No, I mean, I would just add that it shows the importance of kind of independent advice. I know that, a lot of humane system participants are fortunate to have access to outside independent investment advice. And I think that that's of incredible value. So I would just leave it there.
Thank you.
Well, then let's look at the review itself, and it's a very clean review, so we're really pleased with this one. There are only really two funds, I guess really just one fund, even though the PGIM total return bond fund is passing policy guidelines. So we don't have any particular issues with this fund. They've struggled with this interest rate environment. They had the wrong play in terms of, or at least they may be wrong play currently in terms of interest rate movement. And so they've struggled on a year-to-date basis. Their 3-year and 5-year numbers are really well above any performance guidelines that we have as part of the investment policy statement. But that's just the nature, as Mike described, of kind of that change, like the 10-year treasury, the increase in the 10-year treasury, and this is a core plus bond manager, so they have the ability to go upwards of 30% outside the U.S. or below investment grade. They're a very active manager. It just how happens to be the current environment they've been struggling somewhat. Beyond that, you can see the others. I mean, you have a score of a 100. In order for them to score a 100, they're in the top quartile of every quantitative measure that we have. They have a good process in place. They have a good and solid team. And so you have several funds that are scoring a 100. You have 98s, 94s. It's not always going to be this way, so we'll take it. So I'm pleased that we're having the performance we do. And it is important, I guess, to look at the Vanguard target date funds. They continue to perform very, very well. The building blocks of the Vanguard target date funds it's very simple in its construction. It's really 5 index products, and they allocate it differently based on the glide path, based on the percentage of equities of fixed income. And they just have done a really good job over the long time frame of getting low fees and having really solid performance. And then, index products, again, as long as you have flow tracking error, i.e. you're replicating the benchmark and you have low fees, the Vanguard target date fund is known for that. So, the index product. So that's going to be a scoring a green in our valuation. And then CREF stock and TIAA traditional, because there's not a particular benchmark by which to evaluate them. We have a kind of a rubric, kind of a pass-fail based on custom portfolios that they subscribe to actually compare performance on. So we obviously there's no issues with that when we're TI or real estate in terms of hard real estate, etc. So again, it's all good. We don't have any concerns on the fund menu. We don't have anything that's emerging. Obviously PGIM had the wrong play in terms of interest rates in the short term, but beyond that, it's a pretty clean review. We'll take it when we get it. Any questions?
Barry, can you? Oh, sorry.
Yeah. Go ahead. No, any questions before I move it back to Mike on the fiduciary training?
And Barry, maybe just go back to page 14 and we'll leave that up.
Oh, okay, page 14, all right.
Yeah. And
R14 or R14?
Yeah, no, the packet, the overall packet, page 14.
Okay.
And then Kelly, do you want me to just kind of transition right into the next agenda item, which should be a fairly quick one, the fiduciary training?
Sure. And I do have a quick question that actually straddles both topics. The one that you just finished, Barry, and what you've dabbled in a little bit and where you're going, Mike. But this whole thing about the migration and the legacy contracts and the new contracts, the core and monitored menu. Where does our fiduciary responsibility lie? Should we be advocating for education, plan education, so that it's out there and available for the participants to be able to make choices, the appropriate choices? I mean, I'm just wondering where our fiduciary responsibility is in this, if it's something that we need to make available for the participants, or are we going to be in a bad place if we're not offering this stuff for the participants to make those choices? And I know oftentimes the participants won't make those choices on their own, but just a question.
Yeah, so it's interesting, Kelly. It's truly a great question. I mean, there's such a fine line too between doing enough and doing too much, because you certainly don't want to cross that line where you feel like that you're giving advice to participants as well. I think the key is really just providing participants with the opportunity to learn. And I certainly think you do that already. I don't think that there's any exposure there. I mean, you certainly are doing the right thing. TIA does have a process in place. Participants can go into managed accounts if they want kind of a level beyond just the basics that they get from TIA. And then beyond that, it's really up to the participant to then go and seek their own independent advice outside of the plan. So I think that you're doing all the right things, from a plan sponsor perspective. I don't think there's any liability there. I will say that we do see some plans that are kind of going to the next level and offering pure independent advice for participants through formal programs, whether that be a CAP Trust participant advice program or some other independent advisory firm program. And there's certainly no requirement to do something like that, but we have seen plan sponsors just by choice offering more than what you folks are. But I think that's that's kind of a separate conversation. But I would summarize it by saying I think you're doing all the right things. I don't think there's any exposure or certainly liability there. And you do want to avoid putting yourself in a position where you feel like as a plan sponsor you're giving advice to participants, because you certainly don't want to be doing that.
Agree with all that.
Yeah.
Mike.
Okay, yes, you're welcome. And so I put up page 14. I'm not going to cover page 14, but one of the things that Barry had mentioned earlier, and I think we continue to emphasize when we get in front of this committee, is that you're not subject to ERISA, but you do follow ERISA standards as a best practice, and that's something that we recommend with all of our public clients. We just think, that that's the right approach to take. Part of the ERISA standards and what the DOL has said is that fiduciaries really should understand their roles. And part of understanding fiduciary roles is making sure that you're periodically going through some type of fiduciary training program. And we actually do fiduciary training in a couple of different ways. One is that we incorporate components of fiduciary training into every single quarterly review. So when you get your quarterly review packet, there's always at least one page, as you can see here on page 14, that goes through, an aspect of fiduciary training. We also think that on an annual to perhaps maybe every 18 months, that committees should go through a more formal fiduciary training program as well. And the way that we do that at CapTrust and the way we've done it in the past with this committee is through what we call a Brainshark presentation. It's essentially a link that gets sent out to members of the committee. It's about a 25-minute fiduciary training program that you would go through that's more comprehensive than what we include into our quarterly review packet. And we're recommending, and certainly the system supports, that everyone on the committee periodically go through that fiduciary training program. So I'm not going to do that today, but what we are going to do as a follow-up to this meeting is send out that Brainshark link. It will come from someone at the university system. And we're asking that at some point between the time that link goes out and the next quarterly meeting, if everyone could, take 25 minutes at their own time frame and go through that fiduciary training. We think that would just be part of what we believe is just a good, solid, overall, sound, prudent fiduciary process that the system follows. Just a quick reminder that what's great about those electronic kind of Brainshark presentations is that it actually documents who has gone through it. And we love that because then we can run a report and show who's gone through it. But in doing so, we also document who hasn't gone through it as well. So if you could just, again, take a few minutes and go through that. We do think that it's a really important program to go through periodically. And again, just kind of keep an eye out for someone from the system. We'll send that out as a follow-up to this meeting. And I'll pause there and see if there are any questions on really the fiduciary training or anything that Barry covered from a plan review perspective or that I covered from a market perspective. And I think Barry, you can probably stop sharing your screen. And Kelly, if there are no other questions, I think that concludes the CapTrust portion.
Well, thank you so much, Barry and Mike, for the quarterly overview and the fiduciary training. And I can't stress enough that 25 minutes, that Brainshark review on fiduciary responsibility. It's really important that each and every one of you take the time before the next meeting to go over it, because we are in a position where it's important that we know what our responsibilities and roles are as a committee. So if you have a chance, it's well done. If I'm going back on fiduciary responsibility trainings that I've participated on in the past, and it doesn't take that long. It's very informative, and I think it would be good to have 100% participation from this committee. So when you do get that link, if you have some spare time to just sit down and watch it, it would be a great thing. So thanks so much. And moving on to tab 4. I'm gonna turn the meeting over to our financial consultants from NEPC to go over the portfolio reviews, Kelly Regan and Jay Rooney. So without further ado, we are running about 15 minutes ahead of schedule. So I'm glad you guys were waiting in the queue there. So,
no problem. Good to see everyone. Good morning.
Morning.
I'll share my screen if that's okay to go through the document. Can you all see this okay?
Maybe just blow it up a little bit, Kelly. Maybe a little bit down. It's truncated the page. Yep, perfect.
Okay, Thanks, Jay. So good morning, everyone. It's good to be with you. Today, we're going to review quarterly market update. We know we're following CapTrust, so we'll provide some comments, but not spend too much time there. So Jay will go through the markets. He'll also talk about some of the top line portfolio performance. And then I will finish up our presentation with just a manager update on performance and go into an ESG update for the group as well. So with that, Jay, I'll turn it over to you.
Great. Thank you very much, Kelly. Good morning, everybody. It's great to see you. Hopefully next quarter or the quarter after, we'll be able to perhaps meet in person at the University of Southern Maine or some other location. But we're about 15 minutes ahead of schedule, so we'll try to get you to end on, before the end of the schedule as well. It obviously appears that CapTrust did an excellent job going through their materials, so I'm not going to spend a whole lot of time talking about the markets, but I will pick out just a couple of salient points on this page. And again, this page on page 100 really highlights trailing performance for all the primarily public asset classes. The markets during the quarter were mixed, but they were really down sharply during the month of September. And you see that in the first column on this page. And that was due to really a confluence of factors, including supply chain interruption, inflation, and also increased Chinese regulation to a certain extent as well. What we really don't highlight well on this page is how well a variety of different asset classes performed in excess of what you see here. So if you go down to the bottom page, you see real assets, which generally aren't ESG focused. And we don't really highlight private equity returns during this time as well. And if you just look at the year-to-date data and the one-year data in the real asset space, you get a feel for what some of these esoteric asset classes, how they perform. And I would have to say private equity had, in some cases, even better performance than what you see down here. So generally with some of these esoteric asset classes, you see returns that are twice as high in some cases than what you see in the public equity market. So I just wanted to put that in context. Even though I did mention a litany of kind of concerns that investors have in the markets, all hope is not lost. If you took a look at the markets in October, and we don't have any data here for you, so I'm going to reel off a couple of numbers. You see that the markets behaved positively generally during the month of October and the first week of November. And that really had to do with a lot of relatively good news. The economy, is gaining strength. Jobs are being added, unemployment's dropping. And the Fed recently announced a tapering, meaning they weren't going to buy quite as many bonds as they buy in the future. And the world didn't fall apart. So we were happy about that. So how did all that affect the markets? During the month of October, the S&P 500 was up 7%. The EFI index, which is international developed markets, up 2.5%. And emerging markets with all the Chinese issues was still up, but up 1%. Fixed income markets were generally flat. During that time, the Bloomberg Aggregate Index had a 0% return. So again, when you start seeing updated performance, hopefully it is stronger than the numbers that we are discussing this quarter. Kelly, if you turn to page 107. I really want to summarize. Well, actually, before I do that, does anybody have any questions about the markets? I assume CapTrust did a wonderful job going through it. They had a lot of great pages there that hopefully you had an opportunity to review. Okay. Seeing that there are no questions, I will highlight performance and a couple of issues in the three funds that we oversee for you. The first one is really the operating fund, and you see the summary here on page 107. If you take a look at the top left, you see there's about $340 million in assets as of the end of the quarter. And as you're aware, there's 3 pools of assets within the operating fund. There's the liquidity pool that makes up about 40% of the assets. During the prior year, that was actually up 50 basis points. Pretty good when short-term interest rates are close to 0 at this point in time. And again, the purpose of that is to provide liquidity for operating expenses. And then you have an income pool, which makes up another 40% of the assets. And that was up 1.9% for the year. And then to top it off, there's a stub piece of roughly 20% in the total return pool. And that was up a whopping 21.9%. So in aggregate, and this is in the top right, you had a return of 5.6% during the past year. That's net of any fees. That exceeds expectations for the operating fund in the last year. And I'm happy to say that managers in aggregate added value. So we're getting good value out of the investment managers. I will say that you're in compliance with your asset allocation policy, or the allocation between the pools and the subcategories. And we have no recommendations to deliver today, and no announcements from any of the managers. And again, Kelly will go into a little bit more detail shortly in regards to the specific managers. If we turn to page 106, we'll just take a quick look at the pension fund. And in the same light, you'll see that the plan has assets of roughly $25 million at the end of the quarter. And the plan has done quite well during that time period, considering the very conservative asset allocation strategy that is employed, because it's a very mature pension plan. Roughly 33% of the assets are in equities at this point in time. And that's really highlighted in that big lighter blue pie piece and that smaller darker blue pie piece right around 4 o'clock. And again, just about all the other assets are balanced funds and or fixed income in nature. Seeing that it was so conservative at the time, it's amazing to see a 12.3% return over the last year. And managers just fell short of the allocation index, meaning in aggregate, managers didn't add value. What Kelly will run through is that you have a handful of managers that have hit home runs, and you have a couple of managers that have struck out more recently. One of the largest managers in this program is Walter Scott. They had a very difficult year, but they came back very strong during the last quarter. Really the only time we've seen adverse markets in quite a period of time, and they outperformed by 120 basis points. So it's great to see that progress, and hopefully that continues well into the future. If we do look at the last, before you move off that, there were two events. The university system did make a contribution of $670,000 during the month of September, which really takes care of 2 quarters worth of benefit distributions. And then lastly, we did a little bit of rebalancing, reducing our allocation to TIPS and reallocating some of that capital to core bonds. Again, TIPS have done incredibly well, and we think the rose is slightly off the bloom there. Lastly, we'll take a look at the MIP program. This is a little bit more detailed. And again, the numbers have been incredibly positive from an absolute perspective. But if you look at the upper left-hand part of the chart, you do see there's about $442 million in the pool. So it's by far your largest pool. And generally, you have a very traditional endowment asset allocation, meaning about 65% of the assets are in diversified equities, and the remainder are diversified fixed income and a small number of more alternative investments. That said, the asset allocation is dramatically different than the average endowment. And you'll see if you look at some pages into the future, the average endowment within this universe has a 13% allocation to private equity and or private real assets at this time. Your fund does not have that allocation, so it impacted returns on the margin, but it also impacts your ranking versus your peer group. Because again, a lot of those private equity assets had returns close to double, public equity markets. And again, we've discussed privates a multitude of times with this committee. But if we do take a look at the one-year numbers in the upper right, you do see incredible returns of 19.4% during the last year, again, exceeding any expectation that most people have on the markets. And your long-term numbers are well over 8 and in some cases over 9%. So great numbers. Where you fall a little bit short, obviously, if you take a look at the one-year data, is that ranking, you end up in the 73rd percentile. And again, I went through the rationale for that in regards to your asset allocation and no allocations to those privates. But you also fall short by about 100 basis points versus the allocation index, meaning managers in aggregate failed to add value during this one-year time period. What is very interesting, and again, Kelly's going to go through this, I did foreshadow it. You have a whole lot of managers that really are doing super things, developing great returns and generating those returns. But there's a small handful, particularly in the international space, which are falling short. And that's something that we're going to analyze for the next quarter meeting. That said, there's no recommendations at this point in time. When we look at asset allocation, you're in compliance with your policy, and we did the same rebalancing that we did in regards to the pension plan, underweighting tips a little bit and allocating some of that money to core bonds. Well, the proof is always in the pudding. We're extremely happy with the overall performance, but there are a couple of managers that Kelly wants to talk about. Before I turn it over to Kelly, do you have any questions I might be able to answer? Seeing none, Kelly, take it away.
Okay, great. Thanks, Jay, for that update. I'm going to move forward to manager performance. And I'm going to focus the majority of my time just on the managers in the MIP portfolio, because there's a lot of overlap with these managers fund and the operating fund. So just to start, I'm going to start focusing on the small mid-cap area because you do passively invest the large cap exposure. And in the small and mid-cap area, you have two managers, Westfield and DFA. And in this blue line here, hopefully you can see me highlighting it. You can see that over the quarter, the combination of these two managers returned 1%, and over the last year, 54%. So very strong absolute performance from these managers. And even better is that when you look at the combination of performance, the benchmark, which is the Russell 2500, it's a small mid-cap index. You can see over the quarter, over the 1 year, and even over the last 3, 5, and 10 years, these two managers have added value above that benchmark. So the combination of these two managers has served the portfolio well. Specifically, when we look at Westfield over the more recent quarter, they've been having some very strong performance, even though growth has underperformed value in the small cap space. They have been doing very well from their healthcare holdings. There's been a lot of M&A activity in the healthcare space, and Westfield's holdings have benefited from that. We have our global equity manager, which is Walter Scott. It's a newer manager in the portfolio. You can see over the quarter, strong performance versus this benchmark, up almost 1% versus the benchmark during the quarter. But you can see that they are lagging a little bit year to date and over the last 1 year. And when we look at Walter Scott, their performance has really been good. When you break it down into quarters, really it was the last quarter of 2020 and the first quarter of 2021 where value started to outperform growth quite significantly. And Walter Scott's not going to participate in those types of managers because they're a little bit more growth focused. So this is in line with expectations. Typically, when markets are up 29% over the last 1 year, Walter Scott will underperform a little bit, just because they were a little bit more focused on downside protection. And that was one of the reasons why the investment committee hired them, was because of their downside protection results. Jay mentioned one area of the portfolio that has not been performing well, and that's international equity. You can see over the last quarter that was down about 3.8%. Over the last 1 year, it was up 19%, which is some strong numbers. But when you look at those numbers versus the MSCI EAFE, which is the index for international developed, you can see some underperformance there. And some of that is due to when we look at the recent quarter, we have managers like Morgan Stanley. They detracted about 5% during the quarter. They did have some holdings in Tencent, which is they can go outside international developed and invest in emerging markets. So they did have some Chinese exposure with Tencent, which is impacted by some of those gaming regulations that we've seen out of China. J.Ho Hambro did okay during the quarter, right in line with its benchmark. You can see some underperformance over the last year to date in 1 year. Very similar story to Walter Scott, where they underperformed in the fourth quarter of 2020 and the first quarter of 2021 when value bounced back. And they have a growth tilt to their portfolio. And then Kabouter is your international small cap manager. Their performance has been disappointing. Our research group's done a deep dive on them. We still maintain high conviction with them. We still very much like their ESG approach. We even saw that with the recent, COVID pandemic, because of the shutdowns, they've actually had more engagement meetings with their companies from an ESG standpoint. They've also seen that because of the pandemic, the companies that they speak to are more open to ESG factors and talking about them, as they've seen that those factors have been very resilient during the COVID pandemic. So more to come on Kabouter. We are going to review them as they fit in your portfolio during our asset allocation review. But at this point in time, still like the manager. It'd be nice to see the manager bounce back. Another point about Kabouter is that in this space, there's been more, companies with lower leverage, higher leverage and higher debt on their balance sheets, more cyclical stocks that have been focused on, the consumer spending and the economic growth that we've seen have been doing very well. And Kabouter invests more in high quality companies with low leverage, and they're focused on long-term growth, secular opportunities, which hasn't benefited them during this time. So still holding true to their process, but something that we'll be looking at on a go-forward basis just to see how it fits in the portfolio for the managed investment pool. In terms of emerging markets, both Aberdeen and Mondrian were down during the quarter. A lot of that is due to China, as it makes up about 30% of the MSCI Emerging Market Index. You can see that having the small cap exposure from Mondrian versus Aberdeen has been a benefit to the portfolio. For example, over the last year, Mondrian's been up 32% versus Aberdeen up 23%. So having that smaller cap exposure in the emerging market space has beneficial. Over the last 1 year, the combination of the managers has returned 28%. And when you look at these top line emerging market equity returns, and you look at these rankings next to these numbers, it's in the top third over the last near term over to the last 3-year time periods. That means that the combination of these managers in your portfolio have outperformed about 70% of other emerging market managers. Fixed income's a nice story for the portfolio. You can see your total fixed income numbers here, which is a combination of managers in the core bond space, in the TIP space, in the bank loan space, and diversifying credit. You can see all the managers that make up your total fixed income listed here. Over the last 1 year, these managers in combination were up 5%, where the Barclays aggregate was down about 90 basis points. So significant value add has been driven by this fixed income space in this low rate environment. You can see over all time periods, these combinations and the managers have outperformed the benchmark. So nice story there. And then Newton's actually going to be coming in later today to talk about their portfolio from an ESG perspective as we get into that section of our agenda. But you can see over here, their performance has been quite strong versus the benchmark on a near-term basis. 1 year, they're up almost 10% versus the benchmark of 7%. So they've done very well versus benchmark. And is a nice diversifier into the portfolio, giving you some diversifying exposures away from just global equities and global fixed income. And then Lighthouse is your long-short equity manager. They are in this portfolio to protect an equity market decline. Over the last 1 year, they have done well above their benchmark. They had a great 2020 when we had that first quarter of equity markets declining. But more recently, you can see some flat performance from them. We've had a rally in the markets in 2021 up until really the third quarter. And they're not going to participate in those types of markets. Longer term, their numbers are great versus benchmark. And then lastly, just wanted to point out one manager in the operating fund, which is PIMCO All Asset. You can see their performance over the last 1 year is up 25.6%, outperforming its benchmark, ranking very well versus peers. They have diversifying exposure with commodities and other inflation sensitive assets. So as Jay mentioned in this market update, commodities have done quite well. They have exposure to that market that's benefited some of their performance. And so this is just one of the managers that's a little bit different than the MIP and the pension portfolio. So I'll stop there and see if there's any questions. I think that before we go to questions, the takeaway is, we're happy with the manager performance. There's a lot of bright spots with the managers. I think the one area that we mentioned we're going to focus on is international equity in the MIP portfolio to see if any changes need to happen there or confirm, that we're comfortable with the portfolio. And we'll do that next quarter with you folks. So any questions from the group?
Yeah, do you mind if I jump back onto Jay's portion of the outline there a little bit? And I, being kind of the newbie here, I'm kind of not wanting to go over too much over ground that's already been plowed. I know that the concept of, or the conversation around private equity as a part of the portfolio has come up a few times over the past few years. And I know that there's some hesitation. I come from a perspective of certainly seeing the numbers that you throw out at this point, and also just fundamentally being relatively well sold on the fact that the space in and of itself is, something that provides some enhanced returns over time and, largely driven by things like liquidity premiums and that type of thing. But one of the challenges seems to be getting at deals, I guess, at the end of the day, if you're not a huge, multi-billion-dollar family office and that type of thing. And from your standpoint, a plan, or a portfolio the size of what you have here, where do you see performance, in real life for those who are, taking part in it? Given the more limited size of the assets that we'd have, and how do they relate to benchmark? And I think, Jay, you're muted still. Yeah.
I am muted. Sorry about that, Jim. I guess I'll take the first part of that, and if Kelly has anything to add, that would be great. I guess I'd revert back to how the median manager did within the universe, and I believe Kelly's kind of working her way to that.
Here, Jay.
Okay, maybe if you just blow it up a tiny bit.
Sorry, this is the fiscal year. Here we go.
Yeah. So if we look at median 1 year, so
21.7.
yeah, 21.7 versus you did 19.4, about 3 or 4 down. So it cost you, there's other factors, so there's probably dozens of factors that go there, and we think the main driver is really PE for the last year. So we expect private equity to generate roughly 200 basis points and again, I'm not 100% sure of these numbers, over and above public equity markets. Part of that is illiquidity premium, as well as access to great deals. And it sounds like you're quite familiar with that. In regards to size, you hit the nail on the head. You can drive a truck through private equity managers that do well and those that do poorly. With NEPC, because we're one of the largest investment consultants in the country, we do have access to a lot of great managers that have put up, top quartile type returns. That said, historically, it's been hard to get access to some of those venture managers that have historically done well, that are fit, that have their allocations filled up with prior managers. So even though your size at 400 and some odd $million is large, it's really not in the range of some of the largest funds where, that really, get a lot of traction in private equity, the multi-billion-dollar public plans, private wealth, family offices of billions of dollars get great deals. But the reality is, because you have the purchasing power behind NEPC, we get access to some great managers. So again, I think on the margin, it's costing you about 200 basis points on 13% of your portfolio. And that's kind of the slippage, from the universe that we see at this point. Private equity is very interesting at this point in time. A lot of institutions, and again, I don't say this to rehash a topic that we've already gone through, but the reality is institutions are expected to put even more money in privates going forward than they do currently, just because the other returns that you can get in the public markets aren't necessarily as strong. So this is an area of heightened awareness, more acceptance, more assets are flowing into it, which does create problems. Though there's a lot of money chasing fewer deals as the days goes on. That's why you need to find niche managers that are young, that are that can seek out deals that a lot of these multi-billion-dollar fundraisers really don't have access to, or wouldn't budge the needle for them. So again, if you were to do privates, we would focus on more niche managers with strong histories rather than the big behemoths out there. I hope I answered that for you. We like privates, but for a variety of reasons, this committee has made decisions not to go down that road. And again, there's nothing wrong with that. It's just understanding where the comfort level of the university system is at this point in time.
I appreciate that.
Any other questions about privates that I might be able to answer?
Jay, just to piggyback from that, I know we've visited this and vetted it thoroughly about a year or two ago, but when you speak of 200 basis points increase on 13% of the portfolio, is that net of expenses?
That is typically, again, the expenses are, there's a performance-based measurement fee, and it is all assumptions. We expect over a market cycle to generate 200, around 200 net of fees. So the reality is, I don't want to get caught up in this, but that 200 basis points would only be on 13% of the portfolio, because that's what the average endowment has for the universe that we compare you to. So it only, 200 basis points, 13%, so that'd be maybe 30 basis points from a composite perspective that would have been, added more recently. And again, this is all back of the envelope. I will say, and I don't want anybody to lose sight of this, the performance numbers from an absolute return are significant that you received in the last year. Everybody should be happy on them. There's always opportunity for improvement, and Kelly and I will be working on that. But and maybe Tracy and Kelly can attest to this. But the returns that you've seen over the last number of years far exceeds the assumptions that went into the planning process, and we're very happy about that. some of that is just the returns to the market, and some of that is structure and manager selection.
And those fees don't take into account the added expenses to the system, correct? It's just on the private equity part?
Yeah, I'm not necessarily sure exactly what you're discussing, but if you were to have us build a private equity program, the fees of the overall program would go up that you pay the investment managers, because the fees, even though returns historically have been very good, the fees are much higher than traditional assets. And there would be a premium that you'd have to pay for our services as well if you were to go down that road. And we've discussed those in details with this group historically. Again, not advocating it. Really, the conversation here was about, why there is a little bit of shortfall versus the peer group. And again, we're very proud of the performance, but looking forward to making improvements in the near future.
Thank you.
Okay. Kelly, do you want us to move on to the ESG portion of the meeting?
Yes, definitely.
Okay. Let me just see where that slide is in here. Here we go.
But Kelly, I'm assuming you're going to be going over this, correct?
Yes, I'm going to go over it. At 10:30, we are going to have Newton join our Zoom meeting to talk about benefits of ESG from their perspective and how they approach it in their portfolio, and give some examples to the committee about some of the holdings they have specifically in the fossil fuel space and how they think about that from an ESG perspective. But I was going to kick it off with just some comments on ESG and really how it relates to the University of Maine system portfolios before they join. Does that sound okay?
That's perfect. Thank you.
Okay, great. So today we're going to give everyone an update on ESG, and just to level set here, when we talk about ESG investing, really what we're talking about is a way that investors look at companies, analyze companies, assess these companies, and look at how these corporations compare to their peers in terms of performance when considering environmental, social, and governance factors alongside financial factors. So just as a reminder, the investment committee approved an ESG policy back in 2016 to really consider ESG factors when you're selecting investment managers and when you're looking at asset allocation. And that was codified in your investment policy statement back in 2016. The policy is really just for the managed investment pool. However, when we identify and when you hire managers for the managed investment pool that are ESG focused, and if we feel that they may be a good fit for the pension and the operating fund, we've hired managers for the pension and the operating fund as well. So ESG is specific to the managed investment pool, but it can flow to the pension and operating fund. I mentioned I'm going to talk about some of the benefits and some of these topics here on this page, and then Newton's going to join the conversation and give you a perspective from really an investor that is talking to these companies about ESG factors and how they analyze it and some of the benefits from their perspective. So when we think about the benefits of ESG, and when the investment committee adopted this policy back in 2016, it was really a desire to take a holistic approach to investing, looking for investment managers that do well by looking at financial analysis on companies, but also consider risks from an ESG perspective. And when we look at this approach, and when the University of Maine system was looking at ESG, it was really just to find managers that invest in best-in-class companies across all factors, and really tying in the values of the University of Maine system through an ESG approach while still enhancing performance, focusing on risk management, and maintaining portfolio construction across a diversified set of asset classes. So, the thinking here was that this approach not only aligns with the long-term investing goals of the managed investment pool, but also has the added benefit of doing good. And more recently, when we think about ESG and some of the benefits that we've seen come out of this COVID pandemic is there's been a number of studies, starting in early 2020 through the end of 2020, really looking at companies that do focus on ESG and how they perform during this financial crisis. And I think it's the reason why I'm bringing it up is one of the areas from the University of Maine Systems perspective, through a number of conversations that Jay and I have had with you over the years, is really focusing on downside protection. And that's really coming out of the 2008 financial crisis. So I think for the system, having this ESG component into your portfolio that can protect assets and has proven to protect assets in the recent downturn from COVID can be a benefit to the managed investment pool. And what some of these studies found from the COVID pandemic is that the stocks of companies that have good ESG characteristics experience less of a downturn. And it was especially in industries that were really impacted by COVID. When we think about retail, restaurants, airlines. And we've also noticed that these issues are becoming more financially material. They're not just feel-good issues anymore. What we really saw with the COVID pandemic is these are becoming more materially financial issues. And ESG is affecting valuations, cost of capital, operating efficiency, and ultimately impacting shareholder value. So I think there's a number of benefits of ESG. I think we were looking at this years before as more of a risk management tool, and now we're really seeing that it can really enhance the performance of companies and ultimately the managers that you invest in that do focus on ESG. And so I just want to talk a little bit about the ESG results and how that's been a benefit to the University of Maine system portfolio. And I've mentioned some of these numbers before, but we really started talking about ESG really through conversations around fossil fuel divestment, which started back in 2013. And so we started analyzing what the portfolio's fossil fuel exposure was back in 2014. And so I'm going to give you some numbers just to compare ESG isn't a divestment approach. It has had benefit on reducing fossil fuel exposure, not solely. There's also been manager changes, asset allocation changes, and then obviously incorporating ESG. But the combination of all that really has significantly reduced portfolio exposure to fossil fuel. So again, ESG was brought in as a more holistic approach, not a divestment approach, but I think it had a secondary outcome, which was a benefit of reducing fossil fuel exposure. And so, for example, back in 2014, when we were looking at all three of the portfolios and total exposure to fossil fuels at that time, it was 5% at a total system level. And when we think about the managed investment pool, pension and operating fund. And today that exposure is less than 2%. It's 1.9%. So we've seen a 61% decrease in fossil fuel exposure, even while total portfolio assets have increased 30% during this time. So pretty significant exposure, even though your asset pool is increasing, your total exposure to fossil fuels have decreased by about 61%, partly because of some of the work that we've done in the ESG space. And so just the last point here is just the commitment to ESG going forward. I've mentioned, some of the points about, the COVID pandemic, and I do think that can impact the future of ESG going forward. We're seeing a lot of more discussions about climate change, social and economic inequalities, and really even how corporations are running their businesses to stay resilient during these times. So I think ESG is going to be more prominent even going forward as a result of COVID. In terms of how institutional investors are thinking about ESG, we've seen a very sizable increase in the number of owners and the number of assets that are going into the ESG space. So for an example, there's an organization called the UNPRI, the United Nations Principle for Responsible Investment. Back in 2016, there was about 1,600 signatories that have signed on to this organization saying that they're going to incorporate ESG into their analysis. And they had about 60 trillion in assets under management. So it was really the commitment when you signed on with the ESG policy in 2016, about 1,600 PRI signatories and 60 trillion in assets. Today, that's 120 trillion in assets, so it's doubled in size. And there's 4,300 signatories, up from 1,600, just in the last 5 years from when you started this ESG approach. So significant growth in asset owners looking at this space and committed to this space. Additionally, we're seeing a lot of flows into sustainable funds or ESG focused funds. In the first 6 months of 2021, there's been about $40 billion of net inflows into sustainable funds here in the US. And that compares, and that's just the first 6 months of 2021, so 40 billion. When we looked at the first 6 months of 2020, that was 20 billion. So it's doubled in the first 6 months of this year versus last year. Again, a lot of the comments of, the focus of COVID and things of that nature, and just more interest in ESG has really been driving some growth in sustainable funds. And then lastly, when we look at some other organizations, specifically institutional assets back in 2016, there was about 4.7 billion of institutional assets that were dedicated to institutional investors that said they were dedicated to ESG, and that's up to over 6 billion today. So there's been an increase on a number of factors, whether it's signatories to the UNPRI saying they're going to incorporate ESG into their investment process, the flows into sustainable funds or investment products that we've seen here in the US, and just the institutional investor space focused on ESG. So I think going forward, ESG is here to stay, and a lot more, there's a lot more attention on it, and a lot more institutional investor focused on ESG. So I'll stop there and just see if there's any questions on any of these 3 topics that I mentioned in terms of benefits, the results for the University of Maine System portfolio, and just the commitment and the future of ESG going forward. Okay, so maybe, I think Newton's going to join in 3 minutes. Maybe we take a 2-minute break, Kelly, and come back to when they join and hear their story about how they think about ESG and their approach to their portfolio, and some examples that they have on how they look at ESG and specifically fossil fuel companies.
Okay, does anybody have any questions in regards to the subject matter right now, or? No. So we take a 2-minute break. Excellent. I've got thumbs up here. Everybody's going to run.
Kelly, can you stop sharing your screen, please?
I can. Yeah. Yeah, I don't see Newton on the call. Yeah, I did tell him just to join right at 10:30. So.
It's a perfect time for a break.
Hi, Lloyd. We're just taking a 2-minute break to allow you and your team to join.
Sure. Hi there. Good
Hi.
morning. Okay, I'll let the others join. Okay.
Okay. Kelly, we have Lloyd and Matt on the line, so we'll let everyone join back and then we can turn it over to them if that sounds okay.
Excellent, thanks.
Kelly, do you want to wait another minute, or it looks like most have popped their video back on?
I think we're all set.
Okay. Okay. As I mentioned, Newton is joining the call to give an update on, how they view ESG, in the Newton portfolio, which is all 3 of the UMS portfolios. It's in the managed investment pool, the pension, and the operating fund. And they're going to talk about some specific examples on how they look at some of their underlying holdings, some of their specific fossil fuel holdings, and how they look at those holdings through an ESG lens, and why maybe an ESG portfolio, such as Newton's, may have some exposure to fossil fuels. So we have Matt Brown, who's one of the portfolio managers, and Lloyd McAllister, which is one of the ESG analysts from Newton. And I will turn it over to you to start your presentation. I did tell them not to put together any material, so they're just going to be talking through those points. Nothing to share at this time. So Matt, I'll turn it over to you to start.
Great. Well, thank you very much for giving us the opportunity to talk to you today. As Kelly said, my role is as a member of the portfolio management team on the real return strategy which you're invested in. And I'm joined by my colleague Lloyd, who is a specialist on our responsible investment team. And Lloyd's actually going to kick off the discussion by just explaining to you Newton's long backgrounds in responsible investments and ESG. And then we're going to sort of move forwards into a couple of the examples at the security level for you.
Thanks, Matt, and good morning, everyone. Feel free to jump in with any questions as we go through. Obviously, happy to take those. I guess from our perspective, the reason we think about ESG when we're making investments is because if we didn't, we think we'd be negligent. These issues can clearly impact company valuations and also clearly impact client interests as well. And so really the way that we think about ESG in our core funds like the Real Return Fund is, firstly, what is the ESG characteristics of this company? How do they depend and impact upon society? How do they impact and depend upon the environment? How do they govern themselves? Then we think about to what extent are those issues creating business risks or opportunities, and to what extent is that incorporated into the valuation. And really that means that then the fund managers can invest with eyes wide open, fully understanding this is one input. There are other inputs, fundamental inputs, macroeconomic, thematic inputs that also go into that decision, but they are investing with their eyes wide open on the ESG characteristics. And so Newton's been doing that for a very long time. It's got a rating of A+ by the UN Principles for Responsible Investment. And climate change is clearly a key structural force within markets, let alone broader society at the moment. And so there's a lot of focus on understanding how does that impact our investments, and how should we think about that when we're doing due diligence before we invest in countries and companies. One example that I think you emailed before about was RWE. And that will clearly flag highly as an emitter when you run the portfolio. It's Europe's largest emitting company. Comes from a starting point of being a thermal coal utility provider. And on that side, RWE is really a transition story for us. They are transitioning their business from being a thermal coal utility to a renewables-based company, and they have a very clearly laid out decommissioning plan for their coal assets. Crucially important for us as well is they're not just doing that without thinking about the social consequences around the redundancies that will come from that, and are retraining and repurposing those employees where possible into the renewables area of the business. Secondly, to give external credibility to that plan, they have got approval from an organization called the Science Based Targets Initiative, which is about which looks at the pace of decarbonisation in the business and says, is that aligned with the Paris Agreement? And they have managed to get that sign off from that external independent third party body, which is a major achievement, given very few other heavy emitting business models have got that. And so, in addition to that, you can look at things like revenues and profits around the amount of revenues and profits that come from coal. But more important is CapEx, because that's a forward-looking indicator. And on that measure, about 80% of CapEx is being put into renewables. So it's clearly a main part of the forward-looking plans of the business. And all of these plans have been agreed with local regulators, national regulators, and local unions as well. And so they're really kind of engaging with their stakeholders, understanding what is needed and responding appropriately. So for that reason, I feel very, very comfortable with RWE and what they're doing as a kind of long-term investment in relation to their environmental impacts. I've spoken for a few minutes there, so I'll pause, and please do ask any questions, or I'll pass back to Matt.
Okay, just to sort of build on Lloyd's comments, I'm going to talk about our holding in ConocoPhillips shortly, but yeah, just to sort of re-emphasize Newton's sort of very strong sort of pedigree in this area. We believed in responsible investment, seen ourselves as active stewards on behalf of our clients, going right back to the business's foundation at the end of the 1970s, when we've always voted our UK votes domestically since that time. And then as the firm grew more globally, we then moved to sort of vote our international votes from 2000 onwards, and then started to move towards this more formalized sort of integrated approach. Personally, in terms of ESG, as Lloyd said, I think we would be very much negligent if we didn't take note of the ESG angle. And where I sort of personally view it is ESG is sort of part of the mosaic of sort of factors, risk factors that we're looking at when we're making any investment. And so from a personal point of view, sort of thinking over my investment career, I sort of started out at Newton and in this industry in sort of early 2000s. And then at that time, we had a series of major corporate failures. There was poor practice that went on the governance side. So the G part of the ESG, so companies like WorldCom, Enron, those companies going bust. There was a very direct tie back to the G element of the ESG. And then sort of halfway through my sort of career to date, and sort of close to home for us in the UK, the biggest UK corporate catastrophe of recent times has been that of BP, British Petroleum, which, if you recall, in sort of 2010, they had two major incidents, one with regards to a refinery fire, and then in short succession, they unfortunately had the explosion on the Macondo platform, producing oil in the Gulf of Mexico. So obviously major environmental implications from that, and for the business itself, obviously major implications for shareholders in terms of shareholder value. So these things really are important, and we do therefore integrate them into our considerations. Now, in terms of sort of stocks I'm going to talk to you about, another fossil fuel involved stock within our portfolio, US stock, that's ConocoPhillips. This is a stock where our inclusion of it is consistent with ESG integration. In terms of the backdrop of this holding coming into the portfolio, we established the position in the summer of last year, and our sort of thinking behind this was we felt that we were going to see a period of high commodity prices, and that was going to play out particularly in the energy space, and that arose from supply being relatively tight and investment in this area having sort of fallen quite significantly in recent times, and that was meeting demand, which does continue to increase, particularly in some of the emerging markets, and also as we saw the sort of move through of COVID, as we moved to a more sort of reopening type environment, short-term demand was going to increase quite sharply, and that was likely to result in a squeeze in price. Now, we need to sort of think about this from a real return point of view. It's got sort of real in the name, so we are sort of thinking very significantly about inflation, and as we've sort of seen over the last 12 months, inflation has been elevated and commodity prices, particularly energy, have played quite a significant sort of role in that. So from a portfolio construction perspective, we wanted to have some exposure to this sort of rise in the energy price, and we played that through ConocoPhillips, mindful of the sort of ESG perspective. In terms of sort of the Conoco sort of story, one of the sort of big positives is that their production is largely focused on developed economies where there are pretty high standards in terms of emissions and safety, and they're largely sort of focused on the US. This is in comparison to, say, a company that may be producing in somewhere like Iraq or Russia, where maybe those standards are not so high. Secondly, I guess the main sort of end market for energy tends to be in the Western developed markets. So there's less distance for that energy to travel in tankers and the like if it is already being produced in the US where it's consumed. And then thirdly, clearly there is a challenge in terms of a business producing oil and gas, but Conoco, in terms of its scope 1 and 2 emissions, so these are the emissions of carbon from its own operations, it is working very hard to reduce those. So in terms of methane emissions, it's reduced those by 2/3 and continues to sort of focus on that, looking to reduce that by a further 10% by 2025. They're looking to be net zero by 2050, and that they're seeking to reduce their direct carbon emissions by a third by 2030. And then finally, they're investing a lot of resources behind these projects to reduce emissions. So around $400 million in the last 3 years has sort of been invested behind this. So they're trying to do the best that they can in terms of their business. Demand is obviously the sort of major issue. Demand, as I said, is still there and pretty strong for energy. But we, alongside this investment in Conoco, have also got some very long-running investments in companies that are effectively trying to push against this and are trying to reduce demand for fossil fuel energy. So we've got around 5.5% of the portfolio invested in companies that run renewable energy projects, renewable generation, wind power, solar power, and the like. We've also got around 3.5% of the portfolio invested in companies where the key driver for them is essentially the electrification of the global vehicle fleet, which is obviously a major consumer of oil and fossil fuels, and electrifying that fleet is a major move in the right direction. So we view this very much in a portfolio context, having a position in Conoco, which we hold at the present time. We've been reducing it, and it's probably unlikely to be a long-term position. It's more of a portfolio construction position today, given the sort of inflationary supportive commodity price backdrop we're in. But we've also got quite large commitments to areas such as renewable energy and vehicle electrification alongside that.
Great, thanks, Matt and Lloyd. do you have any comments on how you think about the future of ESG? I gave the committee some reference to just kind of like PRI, signatory growth, flows into sustainable funds, things of that nature. What are you seeing from your perspective in terms of kind of, you know, the importance of ESG going forward and just like the future of ESG from your perspective?
I'll take this, Matt, and then maybe you follow up. What's happening in ESG at the moment is that people are trying to unpick the jargon. I think is the main thing. When people typically hear that a fund integrates ESG, they think that means that environmental considerations are placed above financial considerations. And the UN definition of that is very clear, that ESG integration is around incorporating ESG information to the extent that it's helpful for risk-adjusted returns, not that it overrides risk-adjusted returns. Now, some people don't like that. Some people want the environmental concerns to be front and center. And as an asset owner, you need to weigh up, where do you sit on that? Do you want a core ESG integrated fund, or do you want a sustainable fund that takes more into account these market failures around things like emissions? And that's one piece. So one big thing that's going on in ESG is people are finding their way through all of this jargon and terminology to work out what is it that they want. And that's a big change at the moment. Flows really is only going in one direction. It's moving into sustainable. And that has market consequences, because it means that some companies which look cheap, undervalued, will stay at those permanent undervaluations, because money is just flowing away from those business models which in the long term look very challenged. And that's another kind of dynamic around this. You're having some sort of green bubbles happen, and things get overvalued. And there's that kind of a new dynamic emerging in the market where sustainable non-financial issues are becoming more financial as these negative externalities become internalized into the market. So those are the kind of things that we see going on at the moment. There's a huge question, so I'll leave it there and see if Matt, is there anything you'd add to that?
Yeah, not a huge amount. I mean, University of Maine, yourselves, you've very much been in the vanguard of sort of embracing ESG integration. So I think generally sort of people are, as Lloyd said, are sort of catching up with where you've already sort of got to some time ago. And then, yeah, more at the sort of margin, people are starting to maybe move things the next sort of step further. So sustainable funds, for example, sort of take that sort of one step further and sort of start to introduce sort of red lines and areas which sort of not permitted for investment.
Great, thanks. Kelly, do you or any of the members of the committee have any questions for Newton around ESG or some of the examples that they shared on their portfolio holdings and how they think about incorporating ESG into that?
Any questions from the committee?
Also, Kelly.
So, I guess you've explained this wonderfully, and I thank you for presenting here at the meeting today. I do have, and I think you've already answered the question, but does an ESG strategy, when you're always thinking of that, naturally bring down fossil fuel divestment? Does it address that? And know that that's like an open debate. Is that kind of strategy going to organically bring down fossil fuel exposure over time? And I think you've adequately answered that question, but just want to pose the question in that angle.
Yeah, for us, if you sort of went sort of back in time, this strategy has been around sort of since 2004. You would observe, I don't have the sort of numbers to sort of hand, but you would have observed sort of a reduction in broad sort of exposure to fossil fuel related areas as, as we said, ESG is about sort of highlighting the risk profiles from sort of particular perspectives, particularly with regard to this issue. There's clearly a major environmental risk, and our sort of, although we have had positions such as sort of Conoco on a sort of short-term basis, our view and our sort of thinking here through working with Lloyd and sort of other members of the team is that clearly, the long-term outlook in this space does have major challenges, and over a 2 to 3 year view, while demand will probably increase and production may increase over a 10-year time frame, there's major challenges, and you're going to see a reduction in demand and a reduction in production. And I would not be expecting to sort of hold these positions such as Conoco for into that sort of mature into that sort of time frame because of those risks. So yeah, over time, I would expect this sort of path we've been on to sort of continue.
Thank you.
Kelly, I do have a question.
Go ahead. Chair
It's
Gardner.
for the folks from Newton. It's kind of the opposite of your question. And I'm just curious, as you evaluate different companies to invest in, and you've given some real good examples here in the discussion today, how do you weigh the risk of people moving away from fossil fuel and into these alternative energy forms against the backdrop of whether or not the infrastructure and the availability of energy power or whatever it is we want to talk about is available at a reasonable cost? So it seems like there's a fine line here before, too many companies start switching too quickly. There could be a huge increase in their operating costs and their performance. And I know they're making models out 3 and 4 or 5 years and projecting their financials, but that's, they got to look at the larger collective as to how much is moving so quickly, because I see it happening. I think it's going to happen here where companies are going to move quickly in the States to try to get away from fossil fuel, and the infrastructure to support that's not going to be there. And those that are going to be there are going to be paying very high premiums for it. I think is a good possibility.
Yeah, when we're making investments in the sort of renewable areas, we're deliberately making certain that these aren't sort of stranded assets. They can't sort of hook into the grids. I guess in short term, there have sort of been some increases in costs from the sort of shift to renewables, but as we sort of get scale, and we've sort of seen this with the sort of wind power projects, it's like anything, as the sort of scale builds up, the sort of cost does come down. But yeah, over the short term, there can be some bumpy transitions. I think your point is an excellent one on the infrastructure. And I mean, we've been talking sort of for a very long time about how a lot of the sort of energy infrastructure, just grid networks, are sort of underinvested. And this, I think, this shift is going to sort of focus more investment on that area. So in other parts of the portfolio, in some of these sort of industrial names that we invest in, we are seeking exposure to companies that are sort of providing the sort of the picks and the shovels to the owners of infrastructure to sort of increase the bandwidth, so to enable that power that's being generated offshore, where it's very windy from a wind farm, to get it to where the consumers, to where the industries really need it. There's going to be a big opportunity there, and clearly what's going on with the recent bill in the US, there's going to be some support for money going into that area. But arguably, that's actually one of the sort of best areas of sort of opportunity, because it's sort of maybe going under the radar a bit at the current time, but clearly it needs to happen. And I think we need to get more sort of definition as to sort of who's going to be sort of taking responsibility for it, particularly on the electric vehicle side. So yeah, we're investing behind that quite sort of heavily. But again, sort of certainly parochially sort of looking around Europe, it's a bit sort of patchy as to how the sort of charging networks are sort of facilitated. In some countries, it's been done by the local electricity utilities. In some countries, the car manufacturers are sort of doing it. and in others it's sort of separate infrastructure funds. So I think that's a big area of opportunity. It's certainly one we're looking to sort of tap into, because yeah, it needs to be part of the combined approach.
Yeah. Yeah, it's going to be interesting to watch this technology unfold, because it appears right now that the battery technology is developing very quickly. And therefore, the opportunity to move more cars off from fossil fuel to battery technology, EVs, will happen, I think, fairly quickly. But then you look at where are they going to get their electricity? How are they going to get their electricity to charge these batteries? And at the same time, you've got utilities shutting down coal-fired plants and oil-fired plants. And you know, how well coordinated is all this?
It needs to be managed carefully, and yeah, certainly some countries have found that maybe they've sort of moved a bit too fast and have left themselves a bit exposed, yeah, and sort of dependent upon supplies of gas from Russia. So I think we have to be careful, but I think the sort of path of travel is pretty clear. And actually, on your point on the batteries, so yeah, we do have exposures here. We've got a big exposure in a company called Samsung SDI on the electric vehicle battery side, which has been a very successful holding for us. Another stock we've got, it's an investment trust, and they essentially own a fleet of batteries, which, as you say, the technology is improving there, and they're going to be part of the solution in terms of storing some of this renewable energy that's sort of produced sort of erratically. If we can sort of store some of that and sort of deploy it when it's sort of needed, that can also. So we've got some exposures there too.
Good. Thank you.
Kelly, a quick question. As we look at EVs, one of the concerns I would have is, how do you handle the batteries at the end of life? And as an ESG investor, have you given any thought to getting into this space at all?
Yeah, so the electric vehicle batteries, just some clarification, these are not like the sort of traditional batteries that we're used to. They're much bigger, much more valuable, and to your point, a much higher sort of content of a range of different metals and minerals. So the recycling is going to be very important in terms of sort of management of that process. And yeah, there are a few companies that we've sort of looked at to sort of participate here. One which we sort of have sort of had on the radar screen, we don't own as yet, but is probably likely to be well placed to benefit from it, is a company called Umicore, which is based in Belgium. They're one of the sort of leading sort of metal recycling businesses in Europe and indeed globally. So stocks like that will be beneficiaries of that. And yeah, potentially, 5-10 years down the road, when these vehicles are now starting to sort of come up for scrap, that's going to be quite a big material opportunity, because the value and the content of these batteries is so much more than from what's gone before because of that mineral input.
Could you spend just 2 minutes? This is Jay Roney from NEPC, talking about how you interact with senior management at companies. Do you advocate for change? Do you take an activist approach? That type of thing.
I'll maybe let Lloyd answer that, as that's his area of expertise.
Yeah, we do engage with management a lot. I think it's, we've got to the point where we've held some heavy emitting companies for so long. We're now a kind of trusted advisor to the senior management team. So they come to us with, this is what we're planning on doing, and what do you think about that? And so we're part of organizations like Climate Action 100, which are trying to get heavy emitting business models to decarbonize in a sort of sensible way. We have done a little bit of activism in the past. We've submitted shareholder resolutions, BP, for them to disclose how their capex is aligned with the Paris Agreement. and we worked with management on that resolution. They supported the resolution and it got 98% approval from shareholders, and they now disclose that. And so there's a bit of activist side to it, but it's done in a kind of very, at the end of the day, we are worried about long-term oil demand and stranded assets, and then pouring money into projects that don't yield a return. And I do want to see that money is being spent sensibly within those organizations. And so that's the kind of angle that we come at it from, rather than a sort of really extreme environmentalist agenda. It's about making sure that our clients' money is being spent sensibly within these organizations.
Thank you very much, Lloyd.
Any other questions? This has been extremely valuable. I've really enjoyed this conversation. It's given us a light into ESG investing and being responsible overall for the planet. So thank you so much. Kelly, I'll pass it off to you if you have any closing words.
Just want to say thank you, Lloyd. Thank you, Matt, for your time today. I really appreciate it. And yeah, if there's any other questions for NEPC on the ESG front, I'm happy to answer it. I think the approach that you've done over the last 5 years has been a benefit to the portfolio on a number of fronts, and we went through that today. And so I'm very pleased with the results that, the approach that you approved 5 years ago, and kind of if you look back to where we are now, it's been great for all the portfolios. So I'll take any questions if there are some.
Any final questions?
Great. Thank you, Lloyd. Thank you, Matt.
Thank you, guys. Nice to meet you all. Bye-bye.
Thanks for your time.
Take care.
Goodbye.
Thank you. All right. So that was really nice. Thanks for arranging that, Kelly and Jay.
No problem.
Gave us an inside view of how these fund managers select to be in line with their ESG strategy. So a very good insight. And thanks for the questions. Questions were really great as well. So that brings us to the part of the meeting we're going to go into executive session. Could I have a motion for the Board of Trustees Investment Committee meeting to go into executive session under the provisions of 1 MRSA Section 405(6)(c) to discuss the condition, acquisition, or disposal of real property or economic development if premature disclosure of the information would prejudice the competitive or bargaining position of the University Main System? I have a motion. So moved by Chair Gardner. Second by Trustee McMahon. And Ellen, if I could have you take a roll call, please.
Certainly. Trustee Gardner,
Yes.
Trustee McMahon,
Yes.
Trustee Martin.
Yes.
The motion is carried.
Jay, did you get a message that said to move to a breakout room?
I logged out in error, and I haven't gotten a message. So
All right,
I got that message when I logged out. Oh,
All
there
right,
it is.
Okay, there you go.
Thank you. Sorry about that.
You're welcome.